Hello, I'm Carl Watts from Sunny Accountants, and thanks for tuning into this webinar. It's all about post-Brexit trade agreement. So, Boris has finally got Brexit done, and the UK has entered a new era of trade and relations with the EU. So, having left the trading bloc with a new trade deal, free trade deal, we did hope that businesses would face minimal disruption and avoid tariffs altogether in many cases. However, as January has already shown, it's clear that many businesses are still uncertain about the new rules and regulations under the EU-UK free trade deal and the prior withdrawal agreement, which sets out how trade, travel and work will be conducted in the future. So with so much confusion, complexity, and not to mention the 1,000 pages of the post-Brexit trade agreement, this presentation seeks to settle some of the immediate issues that many businesses are now facing. So the new trade agreements. Since the 1st of January this year, the process for importing and exporting goods has changed, and businesses now must make export and must now make export and UK exit safety and security declarations for all goods leaving the UK and entering the EU. Businesses that import and export must undertake certain steps under these new customs arrangements. We've got this new concept known as the core model. To help businesses adapt, HMRC will introduce the new border and customs controls via a new core model, which will be delivered in 3 stages up until the 1st of July 2021. This will help businesses with the requirements of importing goods into the UK. So we're just going to go through the stages now in this new core model. The first stage, that's already started, 1st of January 2021. Customs declarations will be needed for controlled goods and excise goods. This is things like alcohol and tobacco products. There'll also be physical checks at the point of destination or approved premises on all high-risk live animals and plants, and a requirement to pre-notify for certain movements of goods. Importantly, though, goods will not be required to enter Great Britain and be checked at border control posts. And then we've got stage 2, which starts from the 1st of April 2021. This will require pre-notification and the relevant health documentation on all products of animal origin, for example, meat, honey, milk or egg products, and all regulated plants and plant products. At this stage, all physical checks will continue to be conducted at the point of destination. On to stage 3, which is the 3rd and final stage. This will take place from the 1st of July 2021, when there'll be full controls in place for all goods that are imported. Goods businesses will have to make full customs declarations at the point of importation. Full safety and security declarations will also be required. Well, for commodities subject to sanitary and phytosanitary controls, these will have to be presented to border control posts, and there'll be an increase in physical checks at the UK border as well. So although this staged approach ensures that businesses importing non-control goods can opt to delay customs declarations for up to 6 months, they've still got to make sure that they keep sufficient records of imported goods in this period. So what do we need to be aware of? Well, there's no mutual recognition of conformity assessment in the agreement. This means that checks on product standards is going to be more difficult. If you want to sell your product in both the UK and in the EU, you may have to get it checked twice to get it certified. On other border issues, there's also no agreement on recognising safety standards for exporting food or of animal origin. This potentially means costly checks for products going into the EU single market. There will, however, be some measures which cut technical trade barriers and the mutual recognition of trusted trader schemes stay in place. This will make it easier for large companies to operate across borders. So what are the steps to take now? Well, at this stage, though it's important that businesses, you need a GB EORI number if you intend to import or export from the EU. If your business makes declarations or gets customs decisions in an EU country, you'll need to get an EU EORI from the customs authority in the EU country where you submit your first declaration as well. Prepare to pay or account for VAT on imported goods, and consider the commercial arrangements and terms of trade. You need to be able to determine the customs value of the goods, confirm the rules of origin, and consider how customs declarations to HMRC systems will be made and the use of a customs intermediary. And businesses in certain industries may also need to check what export licenses or certificates they require, the marking, labelling and marketing standards for food, plant seeds and manufactured goods, and the rules for exporting or importing alcohol, tobacco and certain oils. And if you move goods into Northern Ireland or via it into the EU, then you can sign up for the government's free trader support service. And you should acquire an X1 EORI number. This free-to-use trader support service is available to businesses of any size moving goods into Northern Ireland. It provides guidance, training, a digital declaration support service, and a little bit of support from customs experts. So the rules of origin. Tariff-free trade with the EU is based around the concept of the rules of origin. So under the EU-UK Free Trade Agreement, tariffs will not be charged where a business can demonstrate that goods meet these rules and are predominantly of UK origin. The simplest way to think about the rules of origin is to give goods being imported and exported an economic nationality. This determines where they've been produced or manufactured, not just where they've been shipped or bought from. So there are two different types of rules of origin, preferential and non-preferential. Under the Free Trade Agreement, the former applies, meaning that the UK and the EU have agreed to remove tariffs for each other's goods. This grants a preference not provided to other nations that don't have such a deal in place. UK goods seeking to enter the EU under this preference have to prove that they are from the UK under the particular rules agreed in this free trade agreement. This prevents a country without a trade deal from accessing the EU market through the UK and vice versa. Generally speaking, the free trade agreement says that goods must be locally sourced or must have had sufficient work carried out on them in the UK. However, already we've seen some conflict with items such as Marks and Spencer's famous Percy pig sweets. They've seen tariffs placed upon them because despite being packaged and developed in the UK, the products themselves are produced in Germany. This matter is in fact far more complicated than this. How it applies to each sector or to each individual item exported and imported between the EU and UK varies. And this only becomes more complicated when you consider more complex manufactured items. The complexity of supply chains can mean that proof of origin can be difficult for traders to supply, and also hard for authorities to assess. So, how do we assess these rules of origin? Well, the first step for a business is to determine what goods being traded. The World Customs Organization has a list classifying every product traded under tariff headings. Each product has a unique code, which is grouped into broader categories, a bit like SIC code for the company's house. So once the good is classified, the next step is to establish its economic nationality, as opposed to simply where it came from. This involves determining the goods value and where the contributions were made in adding value to the final product. If all materials are obtained and processed in just one state, it will be wholly obtained in that country. That would apply, for example, to agricultural produce, raw materials and natural resources. But think about a car for a minute. It could be made up of thousands of individual components down to each individual nuts and bolt, each of which comes from a different supplier. It could be from anywhere in the world. So with multiple components adding value, it can be very difficult to determine origin for some products. In this case, the final product is determined by the location of the last substantial transformation. For preferential origin, such as the EU, UK relies on, substantial transformation is defined through one or a combination of three main criteria. We've got change of tariff classification. So when the work's undertaken within a country results in a change of classification. This is when the work undertaken within a country results in a change of classification. For example, the unique code for car parts, which is 8708, is different to the code for a finished car, which is 8703. So if a country assembles car parts into a finished car, it would qualify as a change of tariff classification. Then we've got the sufficient value added rule. The originating state must contribute a minimum percentage of the value of the product. Each component will have a certain amount of value, calculated as the percentage of the ex-works price of the final good, i.e. the total price of the inputs to the good, exempting transportation and insurance costs. And finally, we've got specific processing. So finished product can qualify when particular specific working processing activities are carried out. For example, a rule may require clothing products to be manufactured from yarn. So the precise rules are very detailed, and they can change for each product depending on what's been agreed in this free trade agreement. Typically, for preferential origin, such as is found in the new free trade agreement, more than 50% of value has to be added to claim origin. But again, it differs for each classification of goods. So complying with the rules of origin. So from January the 1st this year, in order for businesses to benefit from preferential tariffs when imported into the UK or EU, they must claim preference on their customs declaration and declare they hold proof that the goods meet the rules of origin. This can take the form of a statement of origin completed by the exporter on a commercial document, or knowledge obtained and held by the importer that the goods are originating in the UK. So the UK and the EU have agreed a 12-month grace period on this. This means that until 31st of December this year, 2021, businesses don't need to supply declarations from business suppliers in place when the goods are exported. But they must be confident that the goods do meet the preferential rules of origin. Businesses may be asked retrospectively to provide a supplier's declaration after this date. So moving on to continued and new trade with other non-EU nations. So the UK has been reliant on the EU for free trade agreements, and its departure from the Union means, obviously, that it can no longer rely on the existing deal that it once had in place. Thankfully, the UK government's managed to complete a number of continuity deals that maintain similar arrangements with many non-EU countries. This includes Canada, Mexico, and Switzerland. It's also begun to complete entirely new free trade agreements with other nations, including Japan, and is exploring other deals with new nations such as Australia and the USA. Bearing in mind that the EU currently has no free trade agreements with those. In the coming years, the UK should begin to see a number of new tariff-free trade arrangements with a growing assortment of countries. And this should reduce the cost of importing and exporting overseas. In theory, this will open new markets to UK businesses. Moving on to import VAT, lots of questions have been coming up on this particular subject since January this year. So goods that move into the UK from the EU from the 1st of January 2021 onwards will be considered imports, meaning import VAT will be payable and customs declarations will need to be made. So businesses must account for VAT on all goods imported using a postponed accounting system. What this means is that import VAT on goods is accounted for and paid via a company's usual VAT return, rather than paying it immediately at the point of entry. In reality, this means that rather than physically paying import VAT and then reclaiming it on a subsequent VAT return, VAT is accounted for as import and output VAT on the same return, much the same way as a reverse charge would work on a VAT return, that is. Postponed VAT accounting therefore prevents an immediate impact to a business's cash flow when importing. In fact, if a business already imports from outside the EU, then it might see cash flow benefits too from the new system. It removes the need to account for the import VAT typically do. This applies to all goods imported by VAT registered importers to the UK from anywhere in the world, if they're worth more than £135, including those from the EU. In most cases, import VAT should be recoverable by businesses. So how do we account for this import VAT on VAT returns? Businesses have to account for import VAT via the VAT return under the postponed accounting system. This is new. If the goods they import are for use in their business. The business must include its EORI number, starting with GB on its declaration, and its VAT registration number if it's needed. If you haven't yet applied for a GB EORI number, then it doesn't take long, and it's an essential part of importing and exporting goods. And don't forget, you may also need an EU or an X1 EORI number, as we've outlined above. So once you've got your EORI number, you can then account for import VAT on a VAT return when you submit a declaration that releases goods into free circulation from one of the following special customs procedures: customs warehousing, inward processing, temporary admission, end use, outward processing, or duty suspension. Bear in mind, you can only account for import VAT on a VAT return once excise goods are released for use in the UK, also known as released for home consumption. If the business imports goods that are not controlled into Great Britain from the EU between the 1st of January and the 30th of June 2021, they must also account for import VAT on their VAT return. Controlled goods are goods that must have a license to import or export goods, like alcohol or tobacco, and they've got additional duties on them. This rule still applies even if you delay the customs declaration, i.e. if you decide to record the information for your own purpose now and tell HMRC up to 6 months later. UK import VAT duty deferment. So businesses that import goods regularly can set up a duty deferment account, which allows them to delay paying most customs charges, and this includes the import VAT. So through this account, a business can make a single payment each month via direct debit instead of paying for each consignment separately, as would be expected under the usual system of postponed accounting of the import VAT. So under this system, you can pay the duties and the import that you defer during one calendar month as a total sum, either on the 15th of the next month or on the next working day after, if the 15th is not a working day. This means that you can defer duties and import VAT for between 2 and 6 weeks, offering an average of 30 days credit. So this scheme's open to importers or customs agents and freight handlers that work for importers who have an approved deferment guarantee or a waiver in place. So regardless of the method of accounting for VAT on imported goods, checks to ensure that the data on the customs declaration is accurate will continue to be highly important for VAT purposes for all imports. So postponed accounting versus duty deferment. With postponed accounting, the only differentiator from the previous system is that you record and pay for VAT on a return rather than at the border, which of course helps with cash flow. But you must do this for each consignment that comes in. This system's automatic for all import VAT now. With duty deferment, All consignments are combined into a single payment via direct debit, and it allows import VAT to be deferred for potentially longer than postponed accounting. So this system's really intended for those exporting regularly and handling a large number of consignments. Primarily, this will be customs agents or larger businesses, and you must apply for an account before you can use it. Next, I want to talk about VAT registration and place of supply. So businesses must determine the country where a supply takes place for VAT purposes, so that they know where the VAT due is payable. Businesses should be aware that they may continue to create VAT liabilities in other EU member states. This may mean that businesses in the UK require multiple EU VAT registrations within each member state that they trade within. Similarly, if you're an EU business selling to British customers, you need to register for UK VAT as of the 1st of January 21. You're not allowed to sell products to UK consumers if you're not registered for UK VAT. The one exception to the UK VAT registration requirements is for business-to-business remote sellers. Remote sellers don't need to register for UK VAT if they sell digital products only to businesses and or professionals. I mean, this needs to be 100% business-to-business. If you think you or part of your business falls into this category, we recommend you confirm your particular case with HMRC or a professional tax advisor. Businesses need to be aware that the rules for VAT registration differ from one member state to the next. And so it's important that they research this and complete the necessary registrations. Details of the various EU VAT rules can be found on the European Commission's website. When it comes to VAT compliance in EU member states, businesses may need to appoint a fiscal representative. This is a special type of VAT agent for foreign businesses with a VAT registration in another country. They're responsible for the correct calculation and reporting of VAT of their client, and are the first point of call for the local tax office in the case of questions or audits. They're usually held jointly and severally liable for any unpaid or undeclared VAT of their non-resident clients. They therefore typically charge higher fees and often require a bank guarantee or a cash deposit to protect them against any client losses. Businesses dealing with business-to-business sales are likely to want to confirm the VAT details of customers. And the EU VAT registration number validation service allows businesses to check if a customer or supplier's VAT number is valid. UK businesses will be able to continue to use the EU VAT number validation service to check the validity of the EU businesses. But UK VAT registrations will cease to be included. HMRC has developed a service to ensure that UK VAT numbers can continue to be validated. So, what about consignments of value below £135? Well, imported goods in a consignment not exceeding the value of £135 or €150, excluding specific excise goods and gifts, will not be subject to import VAT at the border and will be subject to sales VAT instead. And this is going to end the £15 or €22 VAT exemption thresholds that were previously known as the low value consignment relief. And VAT will be charged on the goods as if they were supplied in the UK. And they're going to be accounted to HMRC on the UK VAT return. This means that businesses selling goods to be imported into the UK with a value not exceeding £135 will be required to charge and collect any VAT due at the time of sale. For UK VAT registered businesses importing goods in a consignment not exceeding this £135 in value that has not been charged VAT at the time of purchase, they can account for this VAT on their VAT return under the usual reverse charge method. Online marketplaces whether involved in facilitating the sale, will be responsible for collecting and accounting for the VAT. For goods sent from overseas and sold directly to UK consumers without online marketplace involvement, the overseas seller will be required to register an account for the VAT to HMRC. So business-to-business sales not exceeding £135 in value will also be subject to the new rules. However, when the business customer's VAT registered in the UK and provides its valid VAT registration number to the seller, the VAT will be accounted for by the customer by means of a reverse charge. Also, with effect from the 1st of January, the distance selling rules no longer apply because the UK is no longer part of the EU. So there's no VAT registration threshold for businesses established outside the UK. So businesses will be required to register for VAT on any value of sales where you become liable for VAT under these new measures. So what about reclaiming VAT in the UK? Well, currently, UK firms incurring VAT in EU countries can claim the VAT back, subject to the national rules, via HMRC's dedicated refund portal for supplies made prior to the transition period. That arrangement is going to remain in place only until the 31st of March 2021, after which time there's currently no specific provision in place to claim for VAT incurred in 2020 under the terms of the withdrawal agreement. VAT incurred after the 31st of December 2020 will have to be made manually to the individual tax authorities concerned. So, impact on services. Post-Brexit, there should be minimal impact on the supply of services. Business-to-business services are treated as though they are supplied where the customer belongs, and that customer must account for the local VAT. This will mean that for UK service suppliers, they'll continue to not charge UK VAT. For business-to-consumer supplies, UK VAT generally applies, and this will remain the same. When receiving services, UK businesses may still have to apply a reverse charge to the receipt of services from non-UK suppliers. This ensures there's no competitive advantage from sourcing services via non-UK suppliers. Sales of digital services to the EU. So after the 31st of December 2020, all suppliers of digital services to consumers in EU member states are liable for VAT in the consumer's member state. The 8,818 annual threshold for cross-border sales of digital services to EU consumers, well, that no longer applies. Organisations will have to charge VAT at the rate where the customer is based and declare those sales to the relevant EU member state. UK businesses that have been using the UK VAT MOS union scheme can continue to use the system, but must register for the VAT MOS non-union scheme in an EU member state. For businesses wanting to continue using MOS, they must register for the scheme by the 10th day of the month following their first sale after the UK leaves the EU. For example, register by the 10th of February 2021 if a sale is made in January 2021. Alternatively, organisations can register in each EU member state where they make sales. Check the EU's Europa website for further information about registering for VAT in EU member states. Non-UK businesses that have previously used UK VAT MOS non-union scheme will now need to register for the scheme in an EU member state. Non-UK businesses need to declare sales of digital services to UK consumers by registering for VAT in the UK and declaring the sales via a UK VAT return. To declare the VAT charge, businesses can register for VAT in each EU member state where sales are made, or register for the VAT MOS non-union scheme in an EU member state of their choice. And as of the 1st of January 21, businesses are no longer able to use the UK's MOS scheme to report and pay VAT on sales of digital services to consumers in the EU. Businesses that sell digital services to consumers in the EU have to register for the MOS non-union scheme in one of the remaining 27 EU member states. The Institute of Chartered Accountants in England and Wales understands many businesses are considering doing that in Ireland. Under the non-union MOS scheme, businesses wishing to use the scheme must register by the 10th day of the month following a sale. For example, if you make a sale in January 21, you'll need to register by 10th of Feb 21. Alternatively, a business can register for VAT in each EU member state where the sales are made. So personal data. Well, both the UK and the EU want data to flow across borders as smoothly as possible, but the agreement also stresses that individuals have a right to the protection of personal data and privacy, and to quote a line in the agreement, that high standards in this regard contribute to trust in the digital economy and to the development of trade. The EU's agreed to a period of 4 months, extendable by a further 2 months, in which data can be exchanged in the same way as it is now, as long as the UK makes no changes to its rules on data protection. After this period ends, the data rules are likely to remain relatively unchanged, as UK businesses will need to comply with UK data protection law, which is enshrined in the Data Protections Act of 2018. Looking ahead, businesses will also need to comply with any changes to EU GDPR if they offer goods or services, to monitor the behaviour of individuals in the EEA or of branches or offices in the EEA. Businesses should still consider their current compliance documentation and whether it needs to be updated or revised to deal with changes resulting from Brexit, including a review of data protection, impact assessments, records of processing activities, privacy policies, and agreements relating to the transfer of personal data. Moving on to retaining and recruiting talent. So the end of the transition period also signifies the end of the free movement agreement between the EU and the UK. So this means that steps need to be taken to retain existing talent or recruit new talent where the employee is an EU citizen. Employers should check whether existing employees from EU member states need to apply to the settlement scheme. So a person's eligible for settled status if they started living in the UK by the 31st of December 2020 and they've lived in the UK for a continuous 5-year period. 5 years continuous residence means that for 5 years in a row, they've been in the UK, the Channel Islands, or the Isle of Man for at least 6 months in any 12-month period. If they don't have 5 years continuous residence, when they apply, they'll usually get pre-settled status. But to get this, they must have started living in the UK by the 31st of December 2020 and can stay in the UK for a further 5 years. After this, they can then apply to change this to settled status once they've got that 5 years continuous residence. Some EU citizens may be able to stay in the UK without applying. For example, Irish citizens or those with indefinite leave to remain. The deadline for applying for settled status is the 30th of June 2021. Businesses wishing to retain talented EU citizens may wish to help employees to prepare the necessary application. So after the transition period, you can still recruit EU citizens, but you'll need to apply for permission and obtain the necessary visas. To recruit workers from outside of the UK in the skilled worker category in the future, you're going to need to be able to demonstrate that they speak English at the required level. They have a job offer from a Home Office licensed sponsor. The job offers at the required skill level of RQF 3 or above, which is equivalent to A level. and they'll be paid at least 25,600 a year, or the going rate for the job offer, whichever is the higher. If the job pays less than 25,600, but no less than 2480, the applicant may still be able to apply for commission by trading points on specific characteristics against their salary. This new system will not apply to EEA or Swiss citizens already employed in the UK, as they can use the EU settlement scheme. So to become a Home Office licensed sponsor, you do that via an online application and do the following. You need to first of all check that your business is eligible, then choose the type of license you wish to apply for, which will depend on what type of work you want to sponsor. Decide who's going to manage the sponsorship within the business and pay a fee. You'll be given a license rating and be able to issue certificates of sponsorship if you've got jobs that are suitable for sponsorship. This will remain valid for 4 years, as long as you check that your foreign workers have the necessary skills, qualifications, or professional accreditations to do their job. And remember to keep copies of documents showing this. You must only assign certificates of sponsorship to workers when the job is suitable for sponsorship, and tell the UK Visas and Immigration Service if your sponsored workers are not complying with the conditions of their visa. The visa rules are not straightforward, and it's strongly advised that you seek professional advice. So what's the impact on overseas travel? Well, from the 1st of January 21, there are new rules to travel to the EU, Switzerland, Norway, Iceland, or Liechtenstein. Under these new requirements, UK nationals will need a visa if they want to stay in the EU for more than 90 days in a 180-day period. European health insurance cards remain valid until their expiry date, and the plan outlined in the agreement is to replace these with a new UK Global Health Insurance card. So a person doesn't need an international driver's permit to drive in the EU as a UK citizen, so long as they've got a valid UK licence. Should you or any representative of your business need to travel to the EU in future, you may need to consider the following. Check your passport, get travel insurance that covers your healthcare, check you have the right driving documents, tell HMRC that you're going to be working in the EU, check whether you'll need to pay social security contributions in the country you're working in, check whether you need indemnity insurance for your employees, and check you've got the right documentation to take goods into the EU. So working in the EU, UK professional qualifications will not automatically be recognised in the EU. So this could make it more difficult to work in the EU, especially for those in the service sector. Now, it appears that UK citizens will need to apply to the individual country in which they wish to work to get any professional qualifications accepted. Now, this may change as the agreement suggests a framework of mutual qualification recognition in the future. There are measures which commit both the UK and the EU to maintain common standards on workers' rights, as well as many social and environmental regulations. The UK does not have to follow EU law, but they do have to be seen to protect the rules of fair competition. Those looking to work for longer periods in the EU may need to acquire authorisation via a work permit for most EU countries if you're a UK citizen. In most cases, you'll also need a job offer from your chosen country so that you can get a visa to move there. Check with the UK-based embassy of the country you want to work in to see what you need to do. We are here to help. As this presentation has no doubt demonstrated, the various rules relating to the new trading relationship with the EU are complex, to say the least. There are various new requirements that UK and EU businesses need to meet, many of them, which they need to comply with now or in the near future. To ensure smooth and continuous trading, businesses should not hesitate to seek the help of experienced professional advisors to ensure they remain compliant and minimise barriers to suppliers and sales with EU consumers. Our team at Sunny are standing by to assist businesses with this process and any new developments that probably will emerge in this new post-Brexit era. If you'd like assistance with any of the issues we've discussed, please speak with us at the earliest opportunity. Thank you for watching. Bye.